In this video, we are going to take a look at a term rider analysis. We're going to look at two different types of term riders that can be added to whole life insurance policies, specifically designed for maximum cash value, as that's what we specialize in. So the two types of term riders, we have a level term rider and then a one-year term rider, OYT/blended PUA rider. Let's look at the level term rider first, because this is a bit more straightforward. A level term rider means it is level for the period that term lasts. For example, you see 10 and 20 years up on the board. If I go with a level 10-year term rider, say it's $1 million, the cost for that term rider might be $1,500 per year. It is guaranteed to remain level for that 10-year period. I can often remove the term earlier than 10 years. I don't want to do so during the first 7 years in most cases, but I can remove it or reduce it early. Regardless though, it will be fixed for 10 years. It's guaranteed not to increase. After the term period, if I went with a 10-year, for example, that term rider will fall off, it'll expire, or it will renew at a more expensive rate. Typically at that time, I want to make sure I renew it. If I went with a 20-year term, the cost will be a bit higher because I'm extending that term for a longer period of time. However, when it falls off or renews after year 20, could be higher, or I want to make sure I chop it off. Next point, difficult to max fund a policy once the term falls off. So often, one may want to be able to pay in a large amount of money into a whole life insurance policy for a long period of time, specifically focused on that PUA component to accelerate the cash value growth. Often, when using a level term rider, I can max fund a policy. Once that falls off, or if I were to drop it, what happens is I cannot fund up to the same MEC limit, not for a long period of time. What you'll find is when we drop the death benefit, which will happen when we drop a term rider on a policy, that is going to have an impact on the MEC limit. So I've got to be aware of that. I might have to overinflate the MEC from the get-go, or set it up in a manner where if my goal is to pay in for a long period of time, got to be familiar with how that MEC treatment works, but I'm getting too deep here. The PUA flexibility is typically not impacted by a level term rider. And this is more of an insurance company situation here. All companies have different rules around their PUA flexibility. The OYT rider, one-year term. So this one has a lot of popularity. How it works is it is a term rider that renews each year. So specifically there, the cost of the term rider increases each year, the cost per unit. So each year as I grow older, the cost will increase. However, the term rider amount decreases each year. We're going to demonstrate that here shortly as well. You'll see a current charge and a guaranteed charge element. What that means, current charges is what the company charges for the cost of that term rider today. And then you have a guaranteed element, which is what they can charge if they want to. What is very interesting is when you look at, especially the larger mutual carriers, larger mutual insurance companies, they have operated in a non-guaranteed element, non-guaranteed environment for the past 150 years. PUA flexibility is impacted with this rider in a good way, actually. You'll find that we can often add more money into PUAs and really help accelerate the cash value of a policy. Now, let's take a look at a further demonstration. So with this blended PUA rider, and we're going to look at some charts here shortly as well, because we can't resist. Let's assume that I have a total death benefit of $1 million. So I buy a life insurance policy, my total net death benefit is $1 million. If I die, that's what's paid out to you if you're my beneficiary. Okay, we're going to assume that is made up of a $100,000 whole life policy and $900,000 in a one-year term insurance rider. So the purpose of adding a term rider like that is to increase the MEC limit. If cash value is my goal, it could be to increase the death benefit at a cheap rate as well, a cost-effective rate, but it allows me to increase the MEC limit. And here's the big one in my opinion, add more money into PUAs without underwriting. So PUAs stands for paid up additions, paid up additions rider. In our policy design videos, I'll often refer to that English translation, cash dumping. It helps me accelerate the cash value of a life insurance policy, which is what many individuals are interested in. That's what I was interested in when I learned about this, and that's what corporations were interested in. But paid up additions rider, to break down that meaning a little bit, is if I add money into the PUA component, that buys me what's called paid up additional life insurance. Why it has the term paid up is these payments, money I add into PUAs, are not contractually required like base premium dollars are. I have a bit more flexibility with PUA payments compared to base premium dollars. So what it does is it A, accelerates my cash value growth. You'll see that happen every time, especially based off the guarantees. But then B, the whole life death benefit accelerates because I'm purchasing paid up additional death benefit. So as you pay money into a whole life insurance policy, I'm growing the cash value, I'm making PUA payments, my whole life death benefit, which used to be $100,000, is going to increase. For simplicity, let's say it increases to $500,000. What that means is my 1-year term rider will decrease. It originally was $900,000, now it's $500,000. Kind of like that seesaw effect, right? One goes up, the other goes down, keeping my net death benefit at the same $1 million. Now, the 1-year term cost will decrease as the term amount decreases as well. Remember, as I grow older, the cost per unit goes up, but I want to make sure I look at the net costs, net term cost, when I'm looking at these policies. And here's the big thing, in my opinion. So when I add money into PUAs, because a lot of times we'll get this question, is, hey, if I want to dump in $10,000 or $300,000, any amount of money into a whole life insurance policy, if I want to dump it into the PUA component, why would the insurance company give me a hard time? Like, hey, I'm giving you my money. We get that question a lot. And the reason why is if I add, let's say it's $100,000 into a PUA payment for cash value purposes, it buys me paid up additional whole life insurance. That means my death benefit may increase by $300K. The insurance company knows what we're trying to do from a cash value standpoint a lot of times. However, an added death benefit is a liability to them in a sense. They say, hey, why are you adding this money? Did you just find out that you were diagnosed with an illness? You may die sooner. Like, what's going on? We may want to put you through medical underwriting. However, with this 1-year term rider, the liability is removed as long as it's attached. The reason why is if I die when I start the policy or so long into it, if I still have that rider attached, my net death benefit often is not changed. Liability is removed from the company's aspect, which is nice. So let's take a look here. We're going to look at the current and guaranteed elements here as usual to provide more transparency here. Here's a quick example from one insurance carrier. Oh, by the way, anytime we have any examples up here to protect the insurance company's data, we don't show any software or detailed illustrations with company names on it publicly. We try and respect the insurance companies as we've worked with them. So what I will add though is all of the data is from the insurance company's software directly. We don't use any other programs or make the numbers up. So what I want to look at here, current term rates, guaranteed term rates. Paying in $100,000 per year. Cash value, looks great. Breaking even between years 3 and 4. Can do that with a blended PUA rider. You'll see stronger early cash value every single time with this, and 99 out of 100 cases, stronger long-term cash value. If you look at the guaranteed values, 100 out of 100 cases. However, here's what I want to touch on. Term rider cost. So this is a 1-year renewable term cost, meaning as I grow older, the cost of that term insurance increases. However, because I'm plowing money into PUAs, here's my term rider death benefit decreasing. And my net cost as a result is decreasing as well. That's exactly what I want. Keep the costs low. Now, every insurance company does reserve the right to charge the guaranteed maximum. Even though they haven't in over 150 years, they still do. So if I want to see a worst case scenario, which personally I like to look at when I'm looking at any type of purchase, especially something with my money, meaning I'm putting my money in a product where I have access to it. So, term rider. A lot of times after the second year, you can see those costs increase, or when the rates shoot up to the guaranteed cost element. However, what happens here? So we get a jump in year 3, but then what happens? Same thing, continues to decrease. Crossover point cash value between years 6 and 7. Very interesting. What happens to your death benefit in both of these examples? Stays the same, doesn't increase. The reason why, whole life benefit goes up, term rider comes down until I'm all whole life. Now we see it drop here, over here as well. That has to do with another trigger we pulled, reduced paid up. So back to the original piece we looked at here. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.